First of all, let's talk about what is a bond. If you remember back in chapter 4, we said that there were, oh, for shame, she's late. We said that there were discount-only loans, and there are interest-only loans, and those were always at a discount. So basically, let's see, let's start this out. Let me start again. There is a discount loan, and so that is where you loan someone $900 with a promise for them to pay $1,000 at the end. And we have both the principal and interest being repaid on that last day. And then we said there are interest-only loans where we pay interest as we go along, but we're not paying down any of the principal. And it turns out that's how bonds are. And the third type we talked about was the amortized loan, where we're paying back both principal and interest with each payment. So a bond is an interest-only loan. That's all it's getting paid over its life. Oh, for shame, he's late. Okay, so over its life, you're just paying the interest, which means what is due at the end? All of the principal and the last interest payment. Okay, so here's a little vocabulary. Borrowers, the people who issue bonds, are borrowing money. So if they issue bonds, they are selling bonds. They are borrowing money. And who's buying? Well, oh, for shame, she's late. You are the third person today. Okay, so they're selling them to the lenders. So the bond holder or the bond buyer is the lender. They're the one that is loaning money out. And we talked about how they pay interest periodically throughout the life of the bond, and then at the very end, you've got to pay off the remaining interest and that entire principal value right there at the end. And so that's how bonds work. And of course, we'll get more into the mechanics of them here. Let's talk about some bond vocabulary. It used to be that when you were going to collect your interest for a bond, what you would do is there were all these little pieces of paper down at the bottom of the bond, and you would clip them off, and they were called coupons, just like the coupons out of a magazine or a newspaper for cents off on Dove soap or whatever. And so you take the coupon down to your local broker or bank or whoever was handling these things, and you would turn in that coupon and you would receive the money. And so before long, the payments that were received were actually referred to as coupons, even though coupon just means a little piece of paper cut off of a bigger piece of paper. If you buy a bond today, even though there's a 95% chance it's going to be totally electronic, there will not exist in paper form whatsoever, the individual interest payments are still referred to as coupons. The individual interest payments are still referred to as coupons. And then we have the face or par value. The face or par value is that amount of principal that you receive at the end if you buy a bond. The face or par value is the principal that you receive at the end in addition to the final coupon. Now let's talk about the default assumption for face or par value in the United States is $1,000. If I don't tell you otherwise, you can always assume that the face or par value of a bond is $1,000. Let me say that one more time. If I don't tell you otherwise, you can always assume that the face or par value of a bond is $1,000. Now it turns out that the coupons and the face or par value are related through the coupon rate. They are related through the coupon rate. So here's how this works. If I take the coupon rate and multiply it by the face value, I get the annual amount of coupon paid. It's actually worth writing down. The coupon rate multiplied by the face or par value gives me the annual amount of coupon paid. And so if there's only one coupon per year, that's going to be the amount of each individual coupon. But we're going to see, oh, for shame, you are the fourth latest person today. Thought we were going to have an empty classroom, but with all the late people showing up, we're actually going to have a decent crowd.
One of those days.
It is. Okay, so annual amount of coupon. If we have 2 coupons per year, we're going to have to divide that number by 2. If we have 4 coupons per year, we're going to have to divide it by 4. And now let's talk about maturity. Maturity is the amount of time left until the face or par value gets paid. Maturity is the amount of time left until the face or par value gets paid. And we discussed maturity. Oh, you are late person number 5. Even more shame. Okay, so we have maturity. So we talk about maturity in 2 different ways. Number 1 is the original issue maturity. For example, United States government treasury bonds, original issue maturity, 30 years. But what if I've already held it 3 years? Well, that means that the time to maturity now is 27 years. But the original issue maturity is still 30 years. It was 30 years when it was originally issued. And then we have the price. Now, a lot of times students will confuse price and face or par value. And we're going to see that there's one instance in which they will be the same. The price is what you're going to pay if you go out to buy this bond today. The price is what you'll pay if you go out to buy this bond today. Stop that. Okay, now.
Why wouldn't we call that like present value? Instead of price?
Okay, so we're actually going to find out that the price is the present value of all the future cash flows, which are the coupons and that face value. But we call it price because that's what you're going to pay if you go out to get it. So they are related. They are absolutely related. Okay, now, here's what you need to know. Price fluctuates on a daily basis because of what's going on in the market, what's going on with interest rates, what's going on with the risk of the underlying company that's borrowing the money. The face value or par value does not change. The face value or par value does not change. It stays the same, but the price is gonna fluctuate daily. And the reason the price is fluctuating daily is because the required return on the bond fluctuates daily. And what's the required return on the bond? It's the yield to maturity. The yield to maturity is the required return on the bond. Let's say interest rates go up overall in the economy like they have over the last couple of years. What's going to happen to yield to maturities on bonds? It's got to go up, right? Now, what if the underlying company is getting riskier and riskier? What's going to happen to the yield to maturity on the bonds? It's going to have to go up, right? And so we have lots of reasons why this yield to maturity will fluctuate, and we'll talk about those at the end of the chapter. But what you need to know right now is the yield to maturity is the required return on the bond. And the second thing that you need to know is that the yield to maturity is expressed as an APR, or annual percentage rate. And if you remember from chapter 4, we said APR is the sub-period rate times the number of sub-periods in the year. It's the sub-period rate times the number of sub-periods in the year. The most common kind of bond pays 2 coupons per year. And so we'll be taking the 6-month rate and multiplying that by 2 to get our yield to maturity. Now, the yield to maturity and the price are mathematically linked. And it's getting back to what Mr. Nylon was talking about. We've got the present value of a future cash flow, 1 plus R to the T. And so every one of those cash flows that we're going to get from the bond, we're going to find the present value of all of them and add them together. Now let's talk about what happens here. If the yield to maturity goes up, then this thing on the bottom gets larger. And when we divide by a larger number, what happens over here? Yeah, it gets smaller. Alternatively, what if the yield to maturity goes down. We're dividing by a smaller number, so we get a what? A larger number. And so here is, just burn it into your brains. This is what it looks like. As yield to maturity goes down, price goes up. As yield to maturity goes up, price goes down. They're always going to move in the opposite directions because it's governed by this formula right here. It's governed by that formula right there. Every time I read an article about the bond market in the Wall Street journals, they say bond prices move in the opposite direction of yields. And as someone who's been playing this game for decades now, I always laugh. Because, you know, to me, that's like knowing that you need oxygen to survive, right? But keep in mind they're writing the Wall Street Journal to appeal to everyone from students all the way up to hedge fund managers. So they always kind of throw that line in there just in case you're not aware. Questions? Okay. So now we're getting to the idea of what's a bond worth. And if you remember at the very end of chapter 4, I told you that the price or value of anything is the present value of the future cash flows discounted at a rate appropriate to the risk. And so all we've got to do is figure out what are the future cash flows of the firm, or of the bond, sorry, and discount them at the yield to maturity, which we said is the required return given the risk. And so what are those future cash flows? Well, we've got those coupons that are paid over the life of the bond, and they're the same over and over and over again. And then at the very end, we get one more coupon, and what else do we get at the end? Face value. And so it turns out we already know how to figure the present value of both of these things. We can look at those coupons as an annuity. Remember that an annuity is a set of identical cash flows over a fixed amount of time, right? So that's coupons as an annuity. And then we can look at that face value as a lump sum. Lump sums are easy, right? This is the exact formula. So all we have to do is find the present value of both of those things and add them together, and that's going to give us the price or value of the bond. Any questions? Okay, I hope everyone brought their calculator today. I hope everyone brought the calculator. This is a good time to get it out. So here is our very first bond pricing example. A bond with a face value of 1,000. By the way, did I have to tell you the face value was 1,000? Why not?
Yes.
That's the default assumption, right? Only if I tell you it's something different would you not assume that it's 1,000. Got a coupon rate of 6% and 10 years to maturity. The interest is paid annually, and the market requires a 6% return on this bond. Okay, so let's walk through this. We have a face value of $1,000 and a coupon rate of 6%. How much in annual coupon is this thing going to pay?
60.
Yeah, it's going to pay 60. Let me see if I can get this other light on here. Okay, so here's the way to think about this. We're going to take 6% and divide by 100% to get that into a decimal. And then we're going to multiply by $1,000. If my face value is 1,000, just a pretty interesting math here. What happens to these percent signs? Yeah, cancel out. And then what happens to these two zeros? They cancel out. And so basically, for a bond with a par value of 1,000, all you have to do to find out the annual amount of coupon is to multiply by 10. So if it's 6%, it's going to pay 60 a year. What if it's 12%? 120, right? That's all you've got to do. But that's based on the assumption that the face value is 1,000. If it's not, you're going to have to go back and do math the regular way. Okay, so we're going to have $60 per year. Now the next thing they tell us is that the interest is paid annually. How much is the actual amount of each coupon?
What if the face value is 20,000?
Oh, what if the face value is 20,000? Well, let's find out here. So 6 divided by 100, I'm sorry, times 20,000. You multiply your 6 by 200. He keeps me on my toes. In your home country, is it 20,000 for face value? Yeah. So, what's your home country?
Nigeria.
Nigeria. What's the exchange rate between US dollar and Nigerian?
It fluctuates.
It fluctuates, of course.
Like currently, I think, as of today, it's 1474.
So 1,474 units of your currency for a dollar?
Yes.
Does that explain why their face value is 20,000? Or yeah, 20,000. That makes sense. Thank you for bringing that up. Okay, other questions before we move on? Okay, now they also tell us 10 years to maturity. How many coupons is this thing going to pay?
One.
1 per year, and how many years?
10.
10. So it's going to be 10 coupons. Does that make sense? Okay, now it says the market requires a 6% return on this bond. Now I know we've got a couple of 6% here, but this one is, which one of the bond terms is it? Is it the coupon rate or is it the yield to maturity? The second 6%, which is it? Yes, the yield. Remember, we said the yield to maturity is the required return on the bond. So when it tells you the market requires a 6% return, that lets you know that's the yield to maturity. That's the yield to maturity. Okay, now let's get our calculators up and figure out how to price this bond. First thing I want to tell you is we're going to price the bonds with our time value of money keys. And before I do any work with time value of money, what do I always do? Second, future value, to clear that thing out. Okay, now we can go through here. And by the way, it does not matter in which order I enter these things. It doesn't matter. And I'm pretty darn sure 1,000 future value. Why did I put it out there as future value? Because it's a lump sum. That's that face value. If you have trouble remembering, FV could not just mean future value, it might mean face value. So if that helps you remember, good for you. Okay, now let's see. What other kind of cash flow do we have coming off of this thing? The coupons. And how much is the coupon? 60. And what button should I hit next? Payment, because it's making payments of 60. Remember, that's our annuity. Your calculator is going to be able to handle both of these things at the exact same time, which is highly cool. Okay, now what do I put in for I per Y? Yeah, 6, the yield to maturity. 6, I per Y. And what do you think N is? 10. Now I will tell you this, in this case it is both the number of coupons and the number of years. When we get to where we have more than one coupon per year, it's always the number of coupons. It's always the number of coupons. Okay, now, how would I calculate the present value? Compute. PV. And I want you to notice two things here. Number one, it's got a negative sign on it. Why?
Payouts.
Yeah, so it's cash flows in opposite direction, right? And if you think about it this way, I've got to pay this money to get the bond. And once I get the bond, then the money from the coupons is coming back toward me, and the money from the face value is coming back toward me. So here's what you need to remember. The face value and the coupons have the same sign. The face value and the coupons have the same sign. So future value and PMT are going to have the same sign. Future value and PMT are going to have the same sign. Present value or price is always going to be opposite in the calculator. Present value or price is going to be opposite to coupons and face value, also opposite to payment and future value, because that's the buttons we're going to use. Now, it's going to be real easy as long as we're just figuring price, because the calculator is going to do all this work for you. But when we get to dealing with it where we have a price, and future value, and we're trying to figure the payment, we're going to have to remember that sign convention, or we're going to really get messed up. Okay, now the second thing I want you to notice is that this price is exactly the same as the face value. It's exactly the same as the face value. And we have a name for a bond that sells at its face value. We call it a par bond. We call it a par bond. Now, I told you earlier, face value, par value are interchangeable, but nobody's ever going to call this a face bond. So if you call this a face bond, people will think you're touched. If you call it a par bond, they'll know that you know what's going on. So this is a par bond. Now, let's ask this question. Why do you think that this the price is equal to the par value?
There's no compounding.
How about this? If the investor is requiring 6%, and the coupons are exactly 6%, then the coupons by themselves are enough to satisfy the required return. And so they're not going to demand some sort of capital gain on their initial investment. They're only going to take the interest payments that are coming in because they are exactly enough to satisfy the investor's demanded return. Now, what if they were demanding, if yield to maturity was higher than the coupon rate, then the investor is going to only be willing to buy this bond at a discount. Because in order to get their yield to maturity that they desire, they're going to have to get the coupons and a capital gain out of the bond. But we'll get to that here in a minute. Now, how do I know something is a par bond? The yield to maturity is equal to the coupon rate. Write that down. Par bond. The yield to maturity is equal to the coupon rate. I could tell you on an exam, you've got a par bond and the coupon rate is 6%. What's the yield to maturity? The answer? Real easy, right? 6%. So when you read questions, and you could also make the assumption that that par bond was selling for $1,000 because that's always the default assumption. Questions?
Can you repeat that again? The yield to maturity is the same as well?
Okay, for a par bond, the yield to maturity is the same as the coupon rate. For a par bond, the yield to maturity is the same as the coupon rate. Now, how often does this really happen? Rarely, right? Because yield to maturity is constantly doing this out in the market. And so it would be very, very rare to go out there and find a bond that is actually trading at its face or par value. Okay, now let's talk about basically the same bond, but now the yield to maturity has gone up to 7%. The yield to maturity has gone up to 7%. So let's get our calculators out here, and I'm going to demonstrate something to you. I don't have to go back and re-enter all that stuff. It's the same bond, right? All I've got to do is change the yield to maturity. So here I go. I'm going to say 7, and what button should I hit next? IY. And then what am I going to compute? Compute PV. And now this bond is selling for $929.76. And here's why. Remember, we said that there are two ways investors can get a return for owning a bond. Number one are those coupons, and the other would be a capital gain on the bond itself. And so if I'm willing to buy this at a discount and buy it at $929.76, I'm going to get not only the coupons, but I'm also going to get the capital gain as the price rises from $929.76 up to $1,000. Now, let's talk about how this relates to price or interest rate risk. Do you see here that it's the increase in the interest rate that's causing the value of the bond to go down?
Does that mean, though, that you as the creditor is basically loaning them
Okay, yes. So if I, the lender, I'm going to loan them $929.76. In return, what am I going to get? I'm going to get $60 a year plus $1,000 at the end. Yeah, that's an excellent way to look at it. In fact, this is a good point because when people issue bonds, what they try to do is figure out what they think the yield to maturity is going to be that's going to be demanded by the bond buyers. And they're going to try to match the coupon rate to that. Because basically they're trying to figure out how many bonds to issue. If they can get them to come out around face value, it's real easy, right? If I need $1 million, I need to offer 1,000 bonds. I had a friend that worked in private equity out in California. Actually, he worked before private equity, he worked for a company called Calpine, which eventually went bankrupt. But he would get requests, so the capital budgeting people would say, we need $500 million. And he would get on the phone to his investment banker at Goldman Sachs, and he would say, I need $500 million. What do you think would be best for me to do right now? Should I issue regular bonds? Should I issue convertible bonds? What kind of coupons should I offer? And the investment banker would say, well, let me do some digging and I'll get back to you. The investment banker has their finger on the pulse of the debt markets, and they're also familiar with the riskiness of the current Calpine debt that's out there. And so they're going to be able to tell him, hey, by the way, I think you should do straight debt and you should put 8% coupons on that because we think people are going to demand 8% yield to maturity. And that way you'll get $1,000 for each of your bonds. And he said, okay, well, I needed $500 million, so I'm going to take $500 million divided by 1,000, and that'll give me the number of bonds I should issue. Okay, now let's see. We call this a discount bond. We call it a discount bond, and the reason we call it a discount bond is because it sells for less than its face value. Now, is this bond a better deal than the first bond? It's not. They are both fairly priced. They are both fairly priced. And this is something that people don't understand, is they think that a discount bond is like it's on sale, right? It's not. It's fairly priced for the risk, right? Because the price or value of anything is the present value of the future cash flows discounted at a rate appropriate to the risk. This has got to be riskier than the last one. It requires a higher return. So people aren't willing to pay as much for it. They are both fairly priced. In fact, I can only think of one reason to prefer a discount bond over a par bond, and that is because you don't have quite $1,000 to invest. What if I only had $950? I couldn't afford a par bond, but I could afford this thing, right? And they're both fairly priced, so I would be indifferent between investing in these two. Do you guys know what indifferent means? They're both equally attractive to me. It's kind of like when a set of identical twins approaches you for a date.
6 one way, half a dozen.
Yeah, just based on looks, right? Then one says something really nasty to you, and suddenly they've made your mind up for you, right? But until then, you are indifferent between the two.
So if it pays out, it's better, but if it doesn't, you're screwed.
Well, what do you mean if it pays out?
So you said which one is better, and I said this one, right?
Well, no.
That's assuming that it pays out.
Neither one of them. They're both equally attractive, and let's actually think this through. They're equally attractive. This one requires a higher rate of return. What do you think the probability of default is on this bond versus the other one?
Higher.
It's probably higher, and so that would actually make the discount bond a worse deal. But it's fairly priced because that extra default risk is built into that 7%.
So you're getting paid for your risk if
Yep.
it pays out.
Yep. You got to stop saying if it pays out.
Because it's
So
risky, right?
this is all expected values, remember? We expect to receive these coupons. We expect to receive that. And so in the beginning, so if I'm choosing between these two bonds, I am indifferent between them. Do I know whether or not they're going to pay off? No, I don't. But I have adjusted for the probabilities based on my yield to maturity. Okay. Any questions before we move on? Okay, here is example number 3. Bond with a face value of 1,000 as a coupon rate of 6%, 10 years to maturity. In other words, it's exactly the same bond we've been working with. It's exactly the same bond we've been working with. The only difference is now we have a 5% return on this bond. So I'm going to hit 5 on my calculator. What button should I hit next? I for Y. And then how am I going to compute the price? Compute present value. And now we see that this is what we call a premium bond. It's selling for more than the face value. It's selling for more than the face value. Now there's only one reason that that would happen. It's when the coupons are more than enough to meet the required return. Then people are willing to pay a premium for the bond. And so these coupons are 6%. Compared to the required return of 5%, people would be willing to buy this bond at a premium, and they will suffer a capital loss over the value over the life of the bond. Now, I'll show that to you here shortly. But on the last day of this bond's life, you're just seconds away from receiving the face value. What's the value of the bond? It's $1,000, right? Every bond out there ends its life, assuming it doesn't get defaulted on, it ends its life worth $1,000. And so if you've got a discount bond, the value of that bond is going to climb to $1,000 over its life. If you've got a premium bond, the value is going to fall over its life. Why would people be willing to accept a capital loss? Because those coupons are more than enough to satisfy their required return. And by the way, do you think there are other people out there bidding on this bond too? There's like an auction going on, right? And if the true risk of the bond requires 5%, then people are going to bid up the price of the bond until the yield to maturity is exactly 5%. Okay, now we call this kind of bond a premium bond. And you may be used to hearing the word premium used like this. Ooh, it's a premium brand. Look at my new Louis Vuitton luggage. It's premium. Typically, we think of premium stuff being better. Is this better than a par bond? No. Is it better than a discount bond? No. They are all fairly priced given their risk and the coupons that they pay. They are all fairly priced given the risk and the coupons that they pay. Now, what do we know about premium bonds? The yield to maturity will always be less than the coupon rate. For premium bonds, the yield to maturity will always be less than the coupon rate. For premium bonds, the yield to maturity will always be less than the coupon rate. Okay, now we're getting into some interesting territory. It looks like the same bond right up until they say interest is paid semi-annually. What does semi-annually mean? Twice per year. And so how many coupons is this bond going to have? 20. And how far apart are those coupons? 6 months. And so we're going to have to make some adjustments here. And let's go ahead and clear out our calculator. And so just to give us some more practice of putting stuff in. It says the market requires a 5% return on this bond, and they want to know the market price. First thing I want to do is second future value, clear out my time value of money. What should I put in for N? 20, because there are 20 coupons. 20 N. Now what should I put in for I per Y? 2.5, how'd you get that? Yeah, divide 5 by 2. So he took the yield to maturity, which he knows is an APR, and divided it by the number of sub-periods per year, 2, to get the sub-period rate. And it's always the sub-period rate that we put in for I per Y. It's always a sub-period rate we put in for I per Y. So we're going to take 5, divide by 2, and get 2.5. I'm going to say 2.5 I over Y. What should I put in for payment? 30. How did you get 30, Ms. Pierre? Yeah, she says, wait a minute, we're getting $60 per year because she remembers this little calculation right here. We're getting $60 a year, but that's divided into 2 payments. And so 60 divided by 2 is 30. So we're going to say 30 PMT. Now, what is the future value? Yeah, 1,000. And I didn't even have to tell you that. And then what do I do to find the price of the bond? Compute present value. Now I want you to notice that it's still a premium bond, which makes total sense, and it's close in price to the annual that we just did. But is it identical? No. In fact, the present value of this one is a little higher. The price of this one's a little higher. Can anyone tell me why? Compounding. Yeah, semi-annual. Okay, so with the first bond, I buy the bond, and I wait, and I wait, and I wait, and I wait, and at the end of the year, I collect $60. With the second bond, I buy the bond, and I wait 6 months, and receive $30. What can I then do with that $30? Reinvest it, right? And so then I'm starting to get my compounding earlier. I'm earning interest on interest earlier. So anytime you get cash flows earlier in time, it's going to increase the value. So people, all else equal, people would be willing to pay more for a semi-annual coupon bond than for an annual coupon bond. Okay. Now, right there on the bottom, it gives you a clue, maybe something you should have on your note sheet. And that is, for semi-annual bonds, N is doubled, so you multiply the number of years by 2. And I per Y and the payment are both cut in half. I per Y and the payment are both cut in half. So those are the manipulations that you've got to make when you start dealing with semi-annual bonds. Questions? Okay. Now, here we go. We've got a bond with a face value of 1,000, coupon rate of 6%, 10 years from maturity. Interest is paid semi-annually. The bond is selling for $864.10. What is the yield to maturity for this bond? What did we just switch up? Yeah, we've been calculating the present value, but now they've given us the present value and they're expecting us to calculate the yield to maturity. So let's clear out our calculator. Second, clear TVM. What should I put in for face value? Future value? 1,000 future value. Coupon rate of 6%, interest paid annually. What is PMT? It's 30. Right, very good. 30 PMT. Okay, now 10 years to maturity. What should I do for N? 20. Got to multiply it by 2 because there are 2 semi-annual subperiods per year. 20N. And let's see. We're looking for the yield to maturity. The present value. What should I put in for present value?
864.
Yeah, 864.10, but she is absolutely right. We have to put a minus sign on that. Why are we doing a minus sign? Because of the cash flow conventions, right? Cash flow in opposite directions have opposite signs. So now I'm going to hit PV. And then, what am I going to do? What am I going to do? Yeah, compute I per Y. Now, the question is this. Is this the yield to maturity? Yeah, we got to multiply this by 2. We got to multiply this by 2 because this is the subperiod rate. To get back to the yield to maturity, you got to multiply by 2. So I would report that this bond has a yield to maturity of 8%. I would report that this bond has a yield to maturity of 8%. Questions? Okay. A bond has a coupon rate of 6%. Interest is paid semi-annually. Oh no, I didn't tell you what the face value was. However, will we survive? What do we know? It's 1,000, right? It's the default assumption. Interest is paid semi-annually. The bond yields 7% and selling for $973.36. How many years until this bond matures? So this time we're going to be computing N. So let's get our calculator up here and say second clear TVM. What am I going to put in for future value? 1,000. Very good. And what am I going to put in for payment? 30. It's 60 divided by 2. And let's see what else we've got here. The bond yield 7%.
3.5.
Yeah, I got to put in 3.5 because that is an APR. I got to divide by 2. That's I per Y. And then 973.36. What do I need to do with that? Negative. And what button do I hit next? Ooh. PV. Very good. Now what button do I hit? Compute and N. I'm getting 5.999. Is that 6 years? No, what is it? You got to divide by 2 because this is actually the number of coupons, and those are semi-annual coupons. So 6 semi-annual coupons, you'll take 3 years to collect them. Does that make sense? Okay, so it's just remembering what to divide by 2 and what to multiply by 2 is what's really going to give you trouble on the semi-annual coupons. And the sign on the payment versus the coupons versus the present value. So those are the 2 things that screw people up the most. How do you think you're going to get past having trouble with that? Practice, practice, practice. That's it.
So this divide by 2, right?
Yeah, we're going to divide this by 2 because these are semi-annuals. I'm going to divide by 2, and it's going to tell me basically that it's 3 years. Good question. Yes, sir.
How else can we identify the one to divide and the one to multiply?
Well, so remember that an APR is on an annual basis. And if you're doing it twice per year, you know you're going to have to divide that one by 2. And then on the coupon, if you're getting X dollars per year and it's semi-annual coupons, you know you're only going to get half that amount every 6 months. So you know you've got to divide that one by 2.
For coupon?
Yeah, that's for the coupon amount. But what about the number of coupons? How many coupons per year are you getting?
I have to divide it by 2.
No. How many coupons per year are you getting? How many of those semi-annual coupons are you getting per year? Okay, so in our example, we have $60 per year in coupon, right? And we are getting $30 every 6 months. How many of those $30 coupons are we getting per year? 2. And so that means what I need to do is take my number of years and multiply it by the number of coupons I receive per year, which is 2. So if you think through it, of course I've been doing this long enough that it's all perfectly clear to me. So I've got this problem now called the curse of knowledge. I've known this for so long, it's hard for me to give you other ways to remember this, other than to write it on your note sheet. But if you think through them, you should be able to get to the same conclusion.
If you're calculating for percentage, you would multiply it. And if you're calculating for a number of times, then you're going to divide it.
Okay, so that's a way to think about it. So the coupon rate is in percent. The yield to maturity is in percent. And it's percent per year, right? And so if you're getting it twice per year, what do you have to do? Divide by. That makes sense. And then the number of periods is just twice the number of years. Very good. Thank you, Mr. Niles. Okay. Questions? Okay. Now, this one is the nastiest bond calculation I will ever ask you to do. This is the nastiest bond calculation I will ever ask you to do. A bond is selling for $1,071.70 and has 4 years left to maturity. First of all, what kind of bond is this? Premium, discount, or par? It's a premium bond. Therefore, what do we know about the coupon rate versus the yield to maturity? And the coupon rate's going to be larger than the yield to maturity. Or the other way to say that is that the yield to maturity is going to be smaller than the coupon rate. It's got 4 years left to maturity. Interest is paid semi-annually. So we're going to have, our end's going to be 8. The bond yields 5%. What am I going to put in for I per Y? 2.5. Got to divide it. So it's asking, what is the bond's coupon rate? Can we compute the coupon rate directly? No. What are we going to compute in order to get to the coupon rate? Yeah, we're going to compute the payment, and we're going to use that payment then to work backwards to the coupon rate. So that's where we're headed. So get your calculator, and we're going to say clear, second, clear TVM. Now it's got 4 years left to maturity, so I'm going to say 8N. Because there are 2 semi-annual coupons per year, times 4 years gives me 8. Then, the yield to maturity, what should I put in? 2.5. What button should I hit next? I per Y. And we know that 1,071.7. What button do I need to hit next? Negative, because we're going to put this in present value. Cash flows in opposite directions have opposite signs. Now, what do I put in for future value? 1,000. Future value. Okay, I think I've got everything in there now in order to be able to compute the payment. Now, the payment is $35. How much per year does this thing pay in coupon? 70. So we're going to multiply this by 2. And that's how much coupon I'm getting per year. Why is it important to convert it to per year? Because remember, our coupon rate is equal to the annual amount of coupon paid divided by the face value. And we said the face value of this bond is how much? 1,000. And that's going to be equal to 6.9999. In other words, 7%, right? So I can multiply this by 100 to get it into percentages. Okay, now let's assume that you forgot that last bit about multiplying the coupon by 2. Your yield, or your coupon rate would come out to be 3.5%. If the coupon rate's 3.5% and the yield to maturity is 5%, then the bond should be a discount bond, right? You would know that you'd messed up somewhere. You can check your work simply by doing that. Remember when we started out, I told you that we knew that this bond was going to have a higher coupon rate than the yield to maturity simply because it is a premium bond, right? And we know that to begin with. Okay, questions? Now let's talk about pricing zero coupon bonds. What do you think the coupon rate is for a zero coupon bond? 0, very good. And what is 0 times 1,000? 0. So each individual, or how much per year do these bonds pay in coupon? 0. This is the easiest set of questions I've ever given you, right? Now, if you're rational, you would say, it's real easy then. I will, if it's a 10-year zero coupon bond, I will put anything in for payment. I'll put 1,000 in for the future value, and I'll put 10 in for N, and I'll put my full year yield to maturity in, and I'll compute the present value, and it'll all be good. And we would be wrong. And here's why. Strangely, I don't know why. Yes, I do. I'll explain why. Strangely, we price zero coupon bonds. Unless you're told otherwise, we price them as semi-annual bonds. Unless we are told otherwise, we price zero coupon bonds as semi-annual bonds. And here's why. The people who deal with bonds on Wall Street are known as bond traders. Do you think bond traders have a PhD in finance? No. Do you think they have an MBA? No. Do you think they have a college degree? Most likely not. Let me tell you how one becomes a bond trader, or at least did back in the day when they came up with this rule. Do you guys know what a mail room is? The mail, M-A-I-L, the mail comes in, and then it has to be distributed to all the different departments at the brokerage or the bank or wherever it is. And so what kind of person does it take? It takes an organized person who can actually sort out the mail and get it delivered to the right place. If you are good in the mailroom and people like you, then maybe you'll be invited to be a runner, taking orders from the salespeople that are on their phones and running them over to the traders who are actually doing the bond trading. Now, if you manage to do that job and not screw it up, and the bond traders like you, maybe the conversation goes something like this. You see that GE bond there? What do you think is going to happen to the price next? Well, it's been going up all morning, and I don't see it slowing down, so I think it's going to keep going up, which means the yield to maturity is going down. And the bond trader says, I think you're right. And maybe after a few dozen of these conversations, they say, would you like to try a trade or two? And now the runner says, sure. And before long, the runner proves that they have the wherewithal to be a bond trader. Now, where in that whole thing did they get any sort of financial training? Just from observation, right? And what kind of bonds are they seeing being priced? Overwhelmingly, they are semi-annual bonds. And so when I ask one of these people to price a semi-annual bond, how are they going to price it? Or I ask them to price a zero coupon bond. How are they going to price it? Like it's a semi-annual bond. To a man with only a hammer, everything looks like a nail, right? They're going to treat everything like a semi-annual bond unless someone hits them upside the head. That is why we price zero coupon bonds as semi-annual. No other reason. Questions? So, what does this do to the effective annual rate of return? Well, it's actually a little higher because we're compounding, right? So it's going to affect your bond price. That it's something you can play around with your calculator and see the impact. Now let's talk about bond value versus age. I've already discussed this a little bit today, and that is all bonds wind up at 1,000. And I'll give you a terrifying example to help you remember this. When you hold a brand new baby in your arms and you look at this baby and you say, wow, this baby could be a doctor. This baby could be the president of the United States. Or you could dream big and hope that your baby would become a finance professor, right? We don't know. This baby may end up being a criminal, right? We don't know. But we do know one thing with certainty about this baby. What do we know? Well, we don't know that for sure. We have this thing called infant mortality. What do we know for sure? I think I just hinted at it.
That's it. It's gonna die.
Then it's gonna die. Short of a supernatural experience, you are all going to die. And when you hold a baby in your hands, that's all you know for sure, right? That's all you know for sure. Isn't that terrible? That's one of the services I provide, is to introduce you to the concept of your own mortality. Okay, back to the story. How the hell does that relate to bonds? We know, regardless of whether a bond is born as a par bond, a premium bond, or a discount bond, we know how that bond's life ends at exactly the face value. Because remember, here you are, you're a few seconds away from the bond maturing, you just received the final interest payment. How much is the bond worth? $1,000. Now, what does that mean? It means over the life of a premium bond, the bondholder can expect a capital loss. Write that down, because it's a good test question. Over the life of a premium bond, the bondholder can expect a capital loss. Over the life of a premium bond, the bondholder can expect a capital loss. Because they spend more than $1,000 for the bond, and if they hold it all the way to the end, they're going to get $1,000 at the end, which is less than they paid for it. Now, what does that mean about a discount bond, though? Over the life of a discount bond, then they are going to expect a capital gain because they're going to pay less than $1,000 for it, and then over the life of the bond, it's going to get up to $1,000 at the end. Now, one thing that my chart here shows, it's over 15 years, and those lines look incredibly smooth. And you say, well, wait a minute, obviously you have assumed in this picture that yield to maturity stays the same. And that's true. But let me show you what's going to happen if yield to maturity changes over the life of the bond. It may do something like this, but you know where it's going to wind up? Boop, right there at $1,000. And if you're a discount bond, it's going to do something like this as yield to maturity jumps up and down, but at the end, boop, there you are, $1,000. Just like with the baby, we knew exactly where this thing's going to end up, regardless of the things that the bond faces over its life. Does that make sense? Now, the only exception, Mr. Nylon, what's the exception? If the bond gets defaulted on, right? If the bond gets defaulted on, then all bets are off, right? What's default? They don't pay. Does that make sense? But if the bond stays and does as we expect it to, then every bond finishes its life at $1,000 or face value, whatever the face value is in your country.
Obviously, you don't understand finance, because if you're gonna take a capital loss, why would you even buy it?
Because the coupons are more than enough to satisfy your required return. I'm glad you asked that.
You know, you said it already about 5 times, so I should know that, right?
You know, what I found out when I was doing all my education is that I never learned anything the first time someone said it. I learned Calculus 2 and Calculus 1, I learned Calculus 3 and Calculus 2, I learned Calculus 3 and differential equations. I learned differential equations and vibrations, and I never learned vibrations because there wasn't a class that came after it.
Right.
So don't ever feel bad about making me repeat stuff. I know, I'm there, right? Okay, now let's talk about something called current yield. You might think, oh, wait a minute, this is the yield to maturity at the present time. Wrong. Current yield is its own thing. Current yield is its own thing. And in fact, here is the formula for current yield. I'm going to take the annual coupon and divide by the bond price. It's the annual coupon divided by the bond price. It's not the same as the yield to maturity unless, what if it's a par bond? If it's a par bond, then the bond is selling at $1,000, it's selling at face value, and so the current yield would be equal to the coupon rate and the yield to maturity. But that's the only case in which that would be true. What about if I've got a discount bond? Then this thing's going to be greater than the coupon rate, because you're going to be dividing by a number less than 1,000. And if it's a premium bond, this thing's going to be less than the coupon rate. Okay, so let's see here. For discount bonds, the current yield is lower than the yield to maturity because it ignores that capital gain. So it's focused on what the return you're going to get on your investment based on the coupon it is not considering also the capital gain that you're going to get as your bond goes up to face value. And for premium bonds, the current yield is higher than the yield to maturity because it ignores that capital loss as the bond price falls to its face value. What do you need to remember out of all of this? You need to remember that the formula for current yield is annual coupon divided by bond price. Now, let's ask this question. Would it be possible for me to give you the numbers that would allow you to calculate both yield to maturity and current yield? Yeah. All I need to do is give you a little bit of extra information and you can figure out the yield to maturity. Do you think I would be tricky enough to give you enough information to calculate yield to maturity, but then ask you to calculate current yield instead? Ms. Dariani says yes, and she is right. Reading is fundamental, folks. Read the question first. Say, what is he asking for? And if the answer is current yield, whoop, there you go, right? Easy, easy, easy. And you didn't even have to use your TIBA class. You guys could probably do that in your head. Oh, wait a minute. No, you can't, right? You guys use a calculator for everything. It hurts me deeply. Okay. Now, we've talked about this before. Let's talk about it again. Interest rate risk. It's the risk that changing rates will change bond values. So as your interest rate goes up, your yield to maturity goes up, and the price of your bond goes down. That's the bad side of interest rate risk. What happens when interest rates go down, though? What happens to bond prices? Yeah, they go up. And so interest rate risk is your friend when interest rates are going down. Interest rate risk is your enemy when interest rates are going up. Recently, what's been the trend in interest rates? Last 2 years? Up. What do you think's happened to the value of bonds? Down. What kind of people typically are invested in bonds? Old people? You think there were a bunch of old people crying because the value of their bonds was dropping? Oh yeah. Oh yeah. That and they finally recognize their own mortality, right? You're like, crap, I've only got 17 minutes left. What do I do?
So maybe I'm getting a little ahead, but is the yield to maturity the same as yield on a bond?
Yeah.
It is, right?
Yeah, so when we talk about the bond yield, what we're referring to is the yield to maturity, unless I say the current yield.
But then to get the yield on a bond, you have to be given a certain amount of information.
Yes.
And then it's trial and error.
No, it's not. We will not get to trial and error until we start calculating the internal rate of return on a project.
Okay, yeah, all right.
Okay, now, so, first of all, I'm going to teach you a little Latin. Ceteris paribus means all else equal. Ceteris paribus means all else equal. If you hold everything else equal, if the bond has a longer time to maturity, it's more sensitive to interest rate risk. And we can see why that is. If I have a little change in the interest rate here, but I've got a very short time to maturity, like 3 months, so this would be 0.25 years, then this little change in interest rate only gets magnified to the 0.25 power, and it's not a big deal. But what if this is a 30 out here? What if this is the face value of a 30-year bond? That thing is getting magnified to the 30th power. So a little change here in interest rate would get magnified to the 30th power. And so the first thing to remember is the longer the time to maturity, the greater the interest rate risk. The longer the time to maturity, the greater the interest rate risk. That one's real easy in my head to wrap around. But the next one's a little harder. The next one says, ceteris paribus, all else equal. Bonds with smaller coupons are more sensitive to these changes. Bonds with smaller coupons are more sensitive to these changes. Let's explain why that is. Remember that the value of a bond is the present value of all the future cash flows added together. Now, if you had 0 coupons, that's the smallest coupon you can get, by the way, 0, If you had 0 coupons, every single bit, 100% of the price of that bond is all out here at 30 years. It's all out here at the very end. And so every single bit gets magnified to the 30th power. But what if we start to have coupons? Then we've got one part of that bond price is from the first coupon, which is just to the 0.6 or 0.5 power, right? Just to the 0.5 power because it's semi-annual coupons. And then the next coupon is just to the first power. And so those changes in interest rate don't get magnified nearly as much for those early cash flows. And because they represent part of the present value of the bond, overall then the bond is less sensitive to changes in interest rates. And then as the coupons get bigger, 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 they represent a larger percentage of the value of the bond. And therefore your bond becomes less and less sensitive to interest rate risk. So what is the most risky bond you could have from an interest rate risk perspective? It would be a 0 coupon bond with a really long time to maturity. The most risky bond for interest rate risk would be a 0 coupon bond with a long time to maturity. The most risky bond from an interest rate risk perspective would be a 0 coupon bond with a long time to maturity because it would be hitting both of these. And so typically we say long time to maturity, skinny coupons, greater interest risk, greater interest rate risk. So let's work through an example here. We have 2 bonds. One of these bonds is a 1-year bond, and one of them is a 30-year bond. Based on what we just said, which one of those would have higher interest rate risk? Ceteris paribus. Yeah, the 30-year, because it's got a longer time to maturity. Now, we are going to have the same coupon on both of these, so we're just examining that time to maturity angle. And how do I know that these things have the same coupon? Well, we know if we know they've got the same coupon, we know they're at the same yield to maturity to begin with, because at $1,000 they are yielding 10%. By the way, scratch that interest rate down on the bottom and write yield to maturity. Scratch interest rate from the bottom of that and write yield to maturity. Okay, so we know that it got a face value of $1,000 when the yield to maturity is 10%. Can anyone tell me what the coupon rate of the bond is? It's got to be what? What did we say that made the definition of a par bond? It's when the yield to maturity equal to the coupon rate. It's when the yield to maturity is equal to the coupon rate. Well, guess what, folks? At 1,000 with a yield to maturity of 10%, for both of these, that means that the coupon rate must be 10%. By the way, it says it in the caption there, right? They didn't have to tell us that. We can look at the picture and figure it out. Okay, now, we are at 10% yield to maturity. I buy the 1-year bond, and you buy the 30-year bond. And suddenly, interest rates drop, or yield to maturity drops from 10 down to 5. And I'm all excited because my bond has gone up 4.762%. And I call you up on the phone and I'm like, hey, I've got some great news. And you say, what's your great news? And I say, my bond just went up by 4.76%. And you laugh and you laugh and you laugh. Remember, you bought the 30-year bond. What's happened to the value of your bond? It's gone up by 76.86%. You're like, ha, sucker, right? And then you hang up and you celebrate your victory. Okay, now, then some bad things happen. Inflation rears its ugly head. The Federal Reserve starts pulling money out of the economy. Interest rates go up, 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 up. And now we're up to 20% yield to maturity. And my bond is only worth $916.67, which is a drop of 8.33%. And so I call you up and I say, man, I'm really feeling blue. My bond is down by 8.33%. What do you say?
50.
Yeah. I've lost nearly 50%. This is real, folks. So I'll give you an example. I was invited to speak to the 12 or 24, I forget, top clients of a trust company. Do you guys know what a trust company is? So if you got a lot of money and you want to make sure that it gets used in a certain way, even if you die, then you put it in a trust and the trust company manages it for you. What are some of the purposes of trust companies, or of trust accounts? Pay for your kid's education. Take care of your idiot nephew that you know will never be able to hold down a job. Things like that. And so who do you think are the top 12 or 24 clients of a trust company?
The highest well.
Yeah, so I'm talking to like probably the top 12 to 24 wealthy people in Springfield that were free for lunch that day. And they were all old white dudes. And so I get up and I start off, I said, okay, how many of you own 30-year treasury bonds? Everybody, right? Everybody. And I said, the last ones that were sold had a coupon rate of 3.875%. Does that sound about right to you? And they're like, yeah, that sounds about right. By the way, that was what the yield to maturity was at the time, so they were selling for around $1,000 a piece. I told them, look, there's really only one thing we know with certainty in finance. I know it's going to shock you, but there's only one thing we know with certainty in finance, and that is interest rates are mean reverting. What does mean reverting mean? They go back to their average level over time, right? They go back to the average level over time. And so if you have been in a situation where interest rates are high, you can expect them to drop in the future. If you are in a period with low interest rates, you can expect them to go up. 3.875% for a 30-year bond was during this low interest rate period. And I said, okay, we know interest rates are mean reverting, and can anyone guess what the average interest rate on a 30-year bond has been over the last, since 1926? And someone says, yeah, about 7%. I said, you're really close. It was really close to 7%. I said, okay, let's see what happens to the value of your treasury bond if interest rates were to return to their average level. And it turned out that it was going to result in a 43% reduction in the value of their bonds. What do you think happened when I told these old guys that their perfectly safe investment in their mind would possibly lose 43% of its value? So first of all, the color drained from their faces. I thought we were going to have to call an ambulance, right? Do you think I was ever invited back to speak to those? No, keep Haggard away from the clients, right? Okay, so that's a very vivid example of interest rate risk. And, you know, if those guys, for some reason, had to sell out of their bonds. Now, if you don't have to sell out, what can you do? You could try to ride it out and hope that interest rates fall again. Does that make sense? But what if suddenly you needed a liver transplant and you were 64 and a half, so you're not on Medicare, and you make too much money to be on Medicaid? What do you got to do with your bonds? You got to sell them. Interest rates are up currently, you're going to get less for them, right? So there's risk. Questions?
You think most people take them to maturity anyway, or did they wait till the prices are good and then you get dumped?
So I think the majority of people that are going to buy, so the majority of individual investors that will buy a 30-year U.S. Treasury are buying them to hold. That would be my assumption. And what they're doing is, because the majority of people that would buy those, individual investors, are most likely retirees. Why would retirees buy bonds instead of stocks? Lower risk. And what is it about the payment pattern? Right? Yeah, so dividends are not guaranteed. Companies don't have to pay dividends at all. Companies can cut dividends, and companies can raise dividends. So dividends are not a fixed pattern, right? If you're a retiree, you want to make sure that you can eat, right? And so you want to have a certain amount of money coming in. And when we get a little further along, I'm going to tell you a terrible story about some little old ladies And what happened to their ability to go to the country club after a change in interest rates? But that's for next time.